Welcome to the Weekly Option, the podcast for people interested in trading stock options. Each week, we cover trade ideas and opportunities in the stock market right now. Whether you're a beginner, a professional, or just curious about options, this is the show for you. Let's get started. Welcome to the Weekly Option. This is episode 389 on August the 21st, 2025. I'm your host, Eric, and in this week's show, we're going to cover the trades from last week on B. Riley Financial Inc., Core Scientific Inc., and Rigetti Computing. And we discussed three new trades on Opendoor Technologies, Walgreens Boots Alliance, and NIO Inc. Now, it's always great to hear from listeners. If you have any questions about the trades presented here on the show or even about your own positions, feel free to email me. You can email questions to eric@theweeklyoption.com. That's ERIC@theweeklyoption.com. I've also created a few videos to teach you all the basics of option trading that you'll need to know to be able to follow along with me on this show. You can visit our website and click on the videos tab to watch them, or visit the YouTube channel for the Weekly Option. Now, today's show is being recorded one day early. I am heading to a national park tomorrow, and I'm not certain I'm going to have a consistent enough Wi-Fi connection to post the show. So this show is being recorded on Thursday, August the 21st. And for those of you who really care, email me. I can tell you about a moment about 4 years ago, maybe 5, where I completely lost it inside of a hotel lobby because they said they offered Wi-Fi, but they actually only had spotty Wi-Fi at best in the lobby. And the young lady behind the counter finally looked at me with frustration all over her face to match mine and said, "Sir, you are in a national forest." So rather than experience that tomorrow, I'm recording the show a day early. So the Dow Jones Industrial Average has lost 160 points so far this week, closing on Thursday at 44,785 points. The S&P 500 index has lost 79 points, ending the day on Thursday at 6,370 points. Now it's time for the topic of the week. The topic of the week is, which one comes first? Which one comes first? Is it the chicken or the egg? Would it be possible to have an egg if there's no chicken? I won't sit around and pretend to be some sort of philosopher on this one. The real question that people often ask me is whether they should look to only sell spreads or buy spreads if they are trying to create additional income. My response is, it depends. If I sell a 50-cent spread and collect 20 cents, I still have 30 cents of risk online. If I pay 30 cents for a 50-cent spread hoping to gain 20 cents, I could still lose that 30 cents. In many ways, it's the same risk. Your maximum loss is 30 cents and your maximum gain is 20 cents. So there's really no mathematically correct way to answer that question. When it comes to trading, we always need to be considering risk. In this scenario, both trades have the same risk, which is 30 cents. Now, in the case of selling a 50-cent spread at 20 cents, the brokers will still hold the full 50 cents to cover the risk of the spread if it goes against you. That means you're really making 20 cents on 50 cents of risk, which is a 40% return. If you buy a 50-cent spread for 30 cents, then the 20 cents of possible gain is actually a 20 cents return on 30 cents. That would be a 66.67% return on capital. So aside from that perspective, the risk is the same. It really comes down to preference and which one of those you are comfortable adjusting should the market move against you. I hope this helps a little bit. It's just a simple little tutorial that actually isn't that simple at all. You just have to think through it. It's certainly something those of you who are making real trades have considered or should be considering as you manage your risk. All right, let's get into the trades for last week. And thus far this week, we have seen the markets go lower. So rest assured, these trades did not buck the trend. Now we're going to start off with the cover call on B. Riley Financial Inc. Symbol R as in Romeo, I as in India, L as in Lima, Y as in Yankee. At the time, the stock was trading for $6.82 per share. I looked at buying stock and selling the September 7.5 call at 79 cents, hoping for a return of 21.55% in 5 weeks. Shares of Riley Financial lost $1.11, closing on Thursday at $5.71 per share. The call option that we sold lost 49 cents, leaving us with a net loss of 62 cents if we were to close the trade out immediately. Now we are below the break-even point, so making an adjustment seems appropriate. You can buy back that 7.5 call for 30 cents and sell the $6 call at 60 cents, which will just about wipe out your loss on the week. Now, if stock rises from $5.71 to $6, we would still walk away with a 27 cents profit for this trade. Now, that's less than our initial plan, but better than zero, obviously. Of course, you always have the option of giving the stock a little bit of room to see if it's going to head higher before making that adjustment. We still have 4 weeks until expiration, so you don't have to rush to make an adjustment just yet. Either way, do the math and make the decision that works best for your account. Next up, we have a credit spread. We looked at Core Scientific Inc., symbol C as in Charlie, O as in Oscar, R as in Romeo, Z as in Zebra. At the time, the stock was trading for $14.13 per share. I looked at selling the September 14-13 put spread at 39 cents. That could give us a maximum possible loss of 61 cents per spread. Well, shares of Core Scientific fell 34 cents, closing on Thursday at $13.79 per share. The out-of-the-money put spread that we sold is now 21 cents in the money. That means we are losing money on this trade so far. The stock is right between our strikes, but it has not gone below our break-even point just yet. If the stock continues lower, I would look to sell the 15-16 call spread at 20 cents. That would increase the total amount of premium that you've collected to 59 cents, and it lowers your maximum possible loss on the trade overall to 41 cents instead of 61 cents. Again, there's 4 weeks left in this trade, so you can give the stock a little bit of breathing room just to see if it's going to head back higher. Always be aware of how your risk changes when you make these adjustments. If the math works for you, make the adjustment, but always do the math. If you've listened to the show any length of time, you've heard me say, always do the math. You want to understand what's going on, and options, especially with spreads, it's nothing but math. Our final trade from last week was a debit spread on Rigetti Computing, symbol R as in Romeo, G as in Golf, T as in Tango, I as in India. At the time, the stock was trading for $16.65 per share. I looked at buying the September 15-16 call spread for 61 cents. That could give us a maximum gain of 39 cents or a 63.93% return in 5 weeks. Well, shares of Rigetti Computing fell $2.38 so far, closing at $14.27 per share on Thursday. The in-the-money call spread that we bought is now out of the money, and the stock price is well beyond the break-even price by more than $1. Now, someone emailed me once and asked if I actually make some of these trades. I do. It just executes at different prices during the day than what I'm talking about when I use the prices for the show. Now, I think they were shocked by my ability to discuss the wins and losses with the same balanced energy. When a spread goes against me, I remind myself that my risk was capped right from the start. If I traded the stock alone, I would have lost a lot more money. Yes, I lost money on the spread, but my maximum loss on the spread is nearly a fourth of the amount of money that the stock has fallen in the last 4 days, meaning I would have been far more pain if I'd actually traded the stock instead of the options. Now, the main adjustment I like to consider with the debit spread is to turn the long spread into a short credit spread and then sell the downside put spread to create an iron condor. I can collect 41 cents by selling the 15-17 call spread, which will leave me short the 16-17 call spread. Then I can collect 26 cents for selling the 13-12 put spread. That would allow me to fully recoup the 61 cents I paid to enter this trade, plus a few extra pennies. However, the risk of loss on the spread grows to nearly $1 from 61 cents. Now, with 4 weeks left on a volatile stock, I might wait before making the adjustment, just like I said with the others. This week has been a tough one for all of the trades on the show from last week, but they all have time on their side. So you don't have to rush to make an adjustment. Do the math, watch the stocks each day if you're in these trades, and definitely be ready to pull the trigger on an adjustment if the math dictates it. And if not, remember, when you trade a spread, your maximum gain and your maximum loss are known right from the start. So you don't have to make any adjustments if you are comfortable taking the loss on these trades, right? And giving them a little room to breathe. So if it was unlimited loss, I wouldn't give the trades room to breathe. I'd just say, hey, we need to quickly cover these trades or make an adjustment. But because the risk was managed from the start, we have the luxury of waiting to do the right thing on the adjustment. I hope that makes sense. Now, that's it for the review of last week's trades. The trades on today's show are using end-of-day pricing on Thursday, August 21st. All new trades will still use the September 19th expiration for monthly options in September. Let's dive in. We're going to start off with our covered call on Opendoor Technologies, symbol O as in Oscar, P as in Papa, E as in Echo, N as in November. The stock closed on Thursday at $3.60 per share. I'm looking at buying that stock and selling the September 4 call at 65 cents, which could give us a return of 29.17% in 4 weeks. Now you enter this trade by buying stock for $3.60 and selling the September 4 call at 65 cents. This trade makes the most money if stock prices finish above $4 per share. The break-even price is $2.95 per share. In real terms, the stock purchase will require $360 and you'll collect $65 for selling the option. Next up, we have a credit spread on Walgreens Boots Alliance, symbol W as in whiskey, B as in Bravo, A as in Alpha. The stock closed on Thursday at $12.19 per share. I'm looking at selling the September 12 11.5 put spread at 20 cents. That could give us a maximum possible loss of 30 cents per spread. Now you enter this trade by selling the September 12 put at 33 cents and concurrently buying the September 11 half put for 13 cents. This is a credit spread because we are selling the spread, and this trade makes the most money if stock prices expire above $12 per share. The break-even price on this trade is $11.80 per share. In real terms, you will receive $20 per spread that you sell and have $30 at risk. Our final trade on today's show is going to be a debit spread on NIO Inc. Symbol N as in November, I as in India, O as in Oscar. Stock closed on Thursday at $5.53 per share. I'm looking at buying the September 5 half call spread for 30 cents. That could give us a maximum gain of 20 cents, or that's a 66.67% return in 4 weeks. Now you enter this trade by buying the September 5 call for 78 cents and concurrently selling the September 5 half call at 48 cents. This is a debit spread because we are buying the spread, and this trade makes the most money if stock prices expire above $5.50 per share. The break-even price on this trade is $5.30 per share. In real terms, you'll pay $30 to enter this spread, and your maximum gain is $20 per spread. So that's it for this week's show. Thank you guys so much for listening. My apologies for recording the show a day early, but it was really that or run the possibility of not being able to successfully post it tomorrow evening. So I wanted to make sure I got the show out for you guys. Hey, I'm working on some fun things. I'll be making a few announcements in a couple of weeks, things that I think you guys will be interested in, especially for those of you who email me and ask how I decide to make each of these trades. I will be looking at a way of explaining them a little bit deeper here soon. So I've heard you. I'm listening. I'm working on an answer. It's coming soon. Also, next weekend is Labor Day here in the United States. I will still be recording the podcast at its normal time. So don't worry. I'll be staying home next week with sustainable and predictable internet service. So you'll get the podcast at its normal time on Friday, which will be September the 29th. All right. So have a wonderful weekend. And as always, happy trading. Thank you for listening to the Weekly Option Podcast. Please subscribe to our show and visit us at www.theweeklyoption.com. Disclaimer, there is a very high degree of risk involved in trading. The indicators and strategies described in this podcast are for educational purposes only and should not be construed as investment advice. For our full disclaimer, visit our website at www.theweeklyoption.com.